Hello, my name's Claire Murray, and I am managing partner of specialist employment partnership and regulatory firm CM Murray. And I am here today with my partner Corinne Staves to talk about the recent changes by HMRC to the salaried members' tax rules. Just when we thought it was going to settle down after changes to basis period reform and everything else that's thrown at law firms, professional services firms, they now give us this, Corinne. What is happening? What's the existing framework, and what is the change?
Thanks, Claire. Yeah, it's a real period of change, isn't it? Before we get started, I just want to do a big old disclaimer, please. We're not tax advisors, and I think that the main message from today's discussion is that if this might affect you, you need to get advice from a tax advisor. What our plan is for today is to look at the legal and the practical implications of these changes, and that's going to be our focus. But just to set the scene, I think it is worth just looking at those particular salaried member tax rules. You might remember back in 2014, these rules were introduced. The idea was that the revenue wanted to ensure that LLP members were genuinely self-employed LLP members. And they introduced these tests that if you didn't pass, well, actually fail these tests, that they
Mm.
would tax you as an employee rather than as an LLP member. And the tests, they're a little more complicated than this, but broadly speaking, you had to have compensation which was more than 20% variable. So you had to have a significant portion of your compensation had to be variable each year, or you had to have significant influence over the affairs of the LLP, or finally, you had to have capital in the business that was 25% or more of your sort of annual compensation. Sort of if you had a fixed share, you needed capital was at least 25%. So if, for example, your compensation was £160,000, you'd need capital of at least £40,000 in the business in order to fail that last one, condition C. I should stress, actually, Claire, that although it's being taxed as an employee, that didn't actually change your employment law rights. It was just your tax status. You didn't become an employee if you were taxed as an employee by virtue of these rules.
And obviously, what's the flip side? If you didn't fail one of these tests, what's then the main consequence?
Well, you're taxed as an employee, which is a very different system of taxation. From the individual's point of view, it means that the way you've been doing things is wrong. You should have been taxed through PAYE, which would be a big headache. I suppose penalties and interest might be payable if that was relevant. But I think for the business, the biggest concern is that employers' national insurance would be payable, which would increase the tax that's attaches to that profit share by about 14%.
This is huge. I mean, it just entirely changes the commercial basis on which you're operating. So you can see why it is an attractive thing to do. But
Mm.
so tell us about the recent change to the guidance and what that's going to mean in practice.
It doesn't on paper sound like massive change, to be honest with you, but there are two key changes. The first one is the removal of an example that they had in relation to condition C. And there was an example that said that the anti-abuse rule that's existed throughout on these rules um, wouldn't apply if capital for condition C was genuinely a contribution and genuinely at risk in the business. So you said, right, well, if you've genuinely got contribution of capital here and it's genuinely at risk, which by definition all firms can fail, therefore it is at risk, then you're home and dry. You failed condition C, you won't be taxed an employee. And actually in practice, a number of professional service firms relied on that particular provision because it gave great certainty. Things like significant influence, for example, you look at it, what decisions were made, what influence did people have? There's a lot of uncertainty there, but being able to point to that certainty was really useful, and firms found that very appealing.
Yeah.
The second example is unhelpful, is there's a specific example now that the way it's framed is it basically says that if you as a firm say, right, there's been an incremental increase in this person's fixed share, and then you make an equivalent incremental increase to that person's capital,
Mm.
then they're clearly associated, and therefore the main purpose is to fail the condition. The main purpose is to get a tax effect. Therefore, that's going to be discounted. And therefore, you're not failing condition C. You are taxed like an employee.
I mean, just pausing there, that does seem a little unfair from a business perspective because it's not unusual in certain models of professional services firm that, as your profit share increases, your equity increases, that your capital contribution increases as well. I mean, that's not unusual.
No, no, it's really not. And I think that's why this will throw a lot of firms into a bit of a spin because they'll have to look at their arrangements, they'll have to look at their records and decide what are we doing here because this guidance has changed. And what's particularly unhelpful is it isn't a change to the rules. There hasn't been a change of legislation. It's just that the revenue updating its guidance. So the implication there could be that this is how the revenue has always seen it, that this has always been the position, and it's just that firms haven't understood correctly how the rules operated. Now, I think the contrary is arguable too, and I'm sure there will be lots of arguments along those lines, but it introduces an unwelcome level of uncertainty for professional firms when they've got a lot on their plates already this year.
So, what in practice do you think firms sort of should be looking at? What are the range of options? I guess some of them, if you're small enough, you might say, well, you know what? Everyone has some role or another in management. So we fail test B, as an alternative. But for much bigger firms, that's going to be less of an option. So what do you think firms should be looking at?
Well, I think that's a good point, and I think as part of, I think the first step is to take tax advice and understand the implications of this change, and if it does mean something significant for you as a business, because as you say, if you already fail condition B around influence because you have a role in decision making, or condition A because a large proportion of your compensation each year is variable, then it could be that this isn't a concern. But the headache for managing partners is that they might have to go back and rethink all of these points that they thought were settled and they had a certain degree of certainty about. So getting that tax advice, understanding the implications is going to be really important. I think there's going to be a partner management piece here because obviously LLPs are tax transparent. The taxpayer is the LLP member, not the firm in this particular instance, but it's that weird interaction between the LLP and the LLP members as taxpayers. So I think the managing partners and LLPs are going to have to take quite an active role in communicating with members, making sure that there's a degree of reassurance there. If changes are needed, that there's consistency across the member body and that there's no panic in the minds of the individual taxpayers to keep sort of people focused on client service, looking after the team and all the things that professional service firm partners ought to be doing.
Do you think that as part of that communication, it might be that, kind of the senior management team are saying, we're no longer going to be asking for 25% of your fixed share. We're actually going to ask for a more significant proportion, so that firstly, we're not just meeting that test C level, but also we're not having to increase year on year incrementally alongside your fixed share element. I mean, so it could result in firms just saying, we want a greater proportion of capital from you, and that means capital borrowings, and that means kind of going to the bank. And how do you feel about that increased level of exposure as I guess a fixed share partner?
Yeah, I can absolutely see that as being one of the potential outcomes here. I guess it would still be a problem if the only reason for asking those partners for the additional capital is the ongoing failure of condition C. So obviously it would need to be very carefully handled to make sure that it does actually resolve the underlying issue if the firm feels it has under an issue with that particular salaried member tax rule.
So not putting it in the correspondence that the
Yeah,
reason we're doing this, the
no,
reason we're
but
asking for
but
more money is
but that's the point, isn't it? This sort of, the more you think about it, the more complex it becomes. And from a commercial perspective, is that a good idea? I mean, do you really want to be asking partners for extra cash, for more capital at a point at which there's a cost of living crisis? Now, I'm not suggesting for a moment that the professional firm partners are on the breadline. Far from it. There are far more sectors of society that are more deserving of sympathy. But the reality is that people's costs are going up, and we're seeing economic pressures on firms and on profit shares across the board. And therefore, this is not a welcome point at which firms would ask for additional cash. I mean, it goes hand in hand with the highest interest rates we've experienced for quite some time, and the Bank of England, for the time being, are holding interest rates at that level, although they might drop off slightly. So borrowing is not cheap. Who
Mm.
services that borrowing? If it's a cost to the fixed share partner, is it fair that they bear it? Should the firm be bearing some of that cost, all of that cost? And those are complicated questions that are not easy questions to answer. So
And
there's a lot there, Claire.
and also at a time when certainly at least some firms are already going to their bank to ask for additional funding to cover the basis period reform cash flow issues. It's like potentially a little bit of a double whammy, not quite double, but you know what I mean? It's like 1.25 kind of whammy. Um,
I completely agree that this is yet another headache that firms don't want to have to deal with. They're thinking about, are we changing our year end? Should mention that basis period reform changes will affect firms other than those with the 31st of March or 5th of April year end, but that is the vast majority of
mm,
professional services firms, a large number of which have the 30th of April. So in the worst possible position on basis period reform, they have significant cash needs coming down the line. So maybe actually this is the solution, asking for more capital, and you hit hit both at once. But I think that's probably a little too optimistic. I think it is actually just yet another headache for the finance team and managing partners to be dealing with, as I say, at a point when really what they want is their partners to be focused on keeping that turnover high, keeping that profitability high, keeping productivity high, so that the business is as strong as ever.
Hmm, interesting. Are there any other sort of things for senior management to think about? You know, any other key options that you want to highlight?
Yeah, I think we've covered a couple of them already. I think that it's going to force all firms, or it should force all firms, to look at their record keeping to make sure that they're recording decision making really accurately and thoroughly, so that it would stand up to scrutiny with the benefit of hindsight, which is how these things are always viewed. I
Hmm.
think that firms might be looking at their compensation arrangements. I think they might be looking at their governance arrangements. It's a big deal in a professional services firms, and it really um, can cause distraction among professional services firm partners. So it has to be managed very carefully. Some of
Hmm.
this might need to be dealt with pretty promptly. And lots of firms have a year end, the 30th of April, which means we're coming up now to that year end. People like to have these things sorted before the beginning of the next financial year. A month and a bit's not long to get all these things sorted. You might need to think about what the arrangements are for your incoming partners. Are the capital requirements that you're sort of asking of those partners and the partner loan applications that are already in, are those okay in light of the new HMRC guidance? And if they aren't, again, not long to deal with those before the 1st of May, when those partners would be coming in to the LLP. And I think the last point I should stress is that firms might need to look at their tax reserving provisions. I think they should already be under review because of basis period reform and all the complexities that sort of come beyond that with the payment by installments and so on. But the tax reserving provisions and also indemnities. For example, if there are additional tax liabilities, is that an LLP member issue? Is it a firm issue? Who bears the burden of the additional tax if the firm has been running kind of the salaried member response and gets it wrong? Is that the firm's fault, or is it the LLP member's fault? Because some of the tax burden will fall presumably on the taxpayer, the LLP member. How's that fair? So I think that looking at those contractual provisions through this prism will be really valuable.
Hmm. Yeah, you can see people looking carefully at the provisions that were put into their partnership agreements back in 2014 when the rules originally came in,
Mm.
and seeing whether they still withstand scrutiny in following these changes. Hey, well, Corinne, thank you so much. I love talking to you about these things, and that was so helpful and interesting. And I hope if you stayed with us to the end, well, thank you very much. I hope you've enjoyed it too. Corinne is brilliant. She loves this sort of stuff. She's obviously not a tax lawyer herself, but she is just a really big thinker about these sort of partnership, professional services type issues. And I'm sure she'd be delighted to speak with you if you did want to have a chat about this or basis period reform or related constitutional issues. So Thanks so much. Hope you enjoyed it. If you've enjoyed it, please feel free to share it. Share it with your colleagues and friends, and we'd really appreciate that. So thanks so much. Take care.